Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today, Dan talks with Cullen Roche, CIO of Discipline Funds.
For today's rant, did two of our top 10 surprises for 2023 already kind of sort of happen?
And remember, you can email us at feedback@investorhour.com and tell us what's on your mind.
That and more right now on the Stansberry Investor Hour. So, did two of our top 10 surprises already kind of sort of happen? A little bit, maybe?
I think they did.
All right, so the first one, this one didn't happen, obviously, but it gave me some insight into how it might happen. And we're talking about what happened Tuesday morning on the New York Stock Exchange. 84 stocks were halted for volatility just in the first several minutes of trading. And the whole thing was over pretty quick. But what I found amusing about it was that in the end, after investigating, the NYSE said it was a manual error that caused a problem with their disaster recovery configuration. So a manual error. My first image in my head was somebody spilling coffee on a laptop. I swear, that was manual error. Is that like somebody with really fat fingers? They hit the wrong keys. I mean, what is that?
That covers a lot. Yeah, that leaves a lot open for interpretation, for sure. Yeah, and there's still, and they said it's a manual error with the configuration in their disaster recovery program, which, seems like some sort of technical error, right? But there's still, this is why we brought up these sorts of possibilities in the potential surprises episode.
Yep.
Was talking about how stocks could drop, individual stocks or indexes could drop 20% or more, and
some of them did
this
drop
was all over pretty quickly. Yeah.
Some of them did drop 25%. Sorry,
but yeah. So it's, if you weren't paying attention to the first 5 minutes of the markets, it probably didn't affect you too much. But
that's the other thing.
It could have.
That's the other thing. Okay, so manual error in the disaster recovery configuration. They use the word disaster, like the D word.
Yeah.
Why? I would have called it a hiccup. They could have said, hey, there was a little glitch in trading for a few minutes, and it was literally over like, boom, really fast. It was done. And I almost didn't notice it. I wouldn't have noticed it if I weren't on Twitter way too much. And people posted charts of stocks dipping 20% real quick and recovering. But I thought, disaster? Wow, what happens if we get a real disaster? What happens if we get a repeat of October 1987? Which,
definitely.
Yeah,
it definitely hits some alarm bells, I think, for a few people.
Yeah.
It also reminded me of, a couple weeks ago, you remember when there was a manual error with the FAA's flight system?
Yeah.
Well, there was that shut down, grounded flights for like, I don't know how long it was, one morning.
Yeah.
But that turned out to be also a manual error from some contractors who were working in the FAA system. And it was the same sort of thing. It's the flight plan kind of system that used to be manually configured over like the phone. And this, to me, what happened on the stock exchange in New York sounded kind of similar. I think it just shows you that we have all of this technology these days, and people are talking about AI more now, and all of that. The GPT-3. I haven't figured that one out yet, but there's humans behind all of this, and
exactly.
As long as we're around, there's going to be human error in everything.
Right. And the thing about financial markets is like, think of it as like your car. I think the average car has I've heard 3,000 parts, individual parts. That probably includes every little screw or whatever, but there's, I don't know, maybe a dozen systems, right? But there's lots of stuff that can go wrong. It's fairly complicated. So a modern car with a computer in it, it's really complicated, right? So you take it for granted. Then one day the thing has a little glitch or whatever, right? So you don't think about it, you get it fixed, and then there's another, and then there's another, and it's a 20-year-old car, and before you know it, this thing is inconveniencing you horribly, and it breaks down, and your whole life is disrupted. And I feel the same way, except like the financial markets are a car with like 100 million parts, you know? It's just like insanely complex and insanely interconnected. At least in your car, whole systems can fail and you can keep driving the thing, right? But in financial markets, you know, some part of it fails on one side of the world and the whole world just swoons, you know. It can be horrendous. And we saw the interconnectedness like during the great financial crisis and actually a handful of times since then. So when they're talking about these manual errors, you know, guys spilling coffee or fat fingering the keyboard or whatever, I'm like, oh wow, my big 1 day 20% drawdown could come true for the dumbest possible reason.
And it might for the dumbest possible reason.
Yeah,
It's I'm with you. These are why surprises are surprises and mistakes happen.
yeah,
And you gotta you can't exactly prepare for every single risk, but unknown, but that's why they're unknowns. But you kind of
yeah.
these things happen. We got stocks in the airline system getting fat fingered all over the place.
Yep.
So beware.
Right, beware. So our other surprise we talked about was an escalation of the war in Ukraine. And I think you and I were kind of on the fence about this. The US has sent I forget how many Abrams tanks to Ukraine, like 180? And, you know, maybe that constitutes an escalation of the war in Ukraine. I think it's different than what you and I were talking about, but I don't know. It sounds like an escalation to me.
Yeah, I think what did we say? NATO countries getting involved,
Right.
more of them. But yeah, there is something about U.S. tanks being shipped overseas and rolling through Ukraine and/or Russia that does scream escalation to me, at least.
Yeah. And
Something about seeing the tanks. Yeah,
and oh, by the way, US is in NATO, is it not? So
right,
there's
right. Yeah,
there's a whole lot more US on the ground. It might not be people, but it's there.
not to mention all the funding, that's
Sure.
still going on. So
Yeah.
yeah, I mean, I don't think anybody really knows how this is going to end, the war in Ukraine I'm talking about. So it's
Yeah.
doesn't seem to be ending, soon. I don't think. And I think Biden said, "Oh, when they said they're going to send these tanks over, he said, "Oh, we want to end the war," but I okay,
You know.
I don't know, how this does that, but
Yeah, it's like
um,
ending a gang fight by bringing, 5 fresh guys on each side into the battle. It's not gonna end the war. Give everybody
right.
fresh knives. I mean, it's not, that's not gonna end the fight.
Yeah, as
Right.
long as Putin and Russian military wants to keep fighting, I think is as long as this will go on. Unless they get some sort of reason to stop. Uh, you know, uh, that's the only, from my vantage point
Yeah.
across the Atlantic Ocean in amateur hour. Just seeing it. I mean, it's the only thing that makes sense to me, but I could be wrong.
Yeah, my fear with this is that it goes on and that our surprise really does come true and it becomes like, of course, World War III is the glib label I can throw on it, but it doesn't have to be World War III. It can be a major European war, and that would be
Right.
bad enough.
Yeah, and then what impact does that have on the rest of the world? And when what we're talking about, the financial markets and inflation, war is inherently inflationary, so
Mhm.
it could
Yeah.
all just kind of file into that whole story about higher inflation, higher interest rates, this new kind of
Yeah.
era of the sea change, as Howard Marks said.
Yeah, I mean, that is one of the narratives that we're hearing, right? Inflation is over, stocks will soar, everything's fine. But I think a bunch of people like we recently well, we're going to talk with Cullen Roche. He's talking about things being different for the next 40 years. Um, we've talked with Vitaly Katzenelson. He says take the last 20 years and invert it for the next 20. And I've picked up on this and written about it a bunch of times in the Stansberry Digest. And, Marx has his own view on it. He's like, well, do you think we're going to have these tailwinds that we've had for the last 40 years for the next, it's highly unlikely. It's been Goldilocks time. And there's too many people I still think there's too many people looking for a bottom. It just strikes me as the narratives are glib, I feel, and the glibness is dangerous.
I'm with you. I said last week that the quicker people get more optimistic, the more concerned I get.
Yeah.
And, we had the GDP, the fourth quarter GDP number came out the other day, which was still growing, 2.9%, I think it was. So I think people are still seeing, now people are talking about, oh, the soft landing. Is it possible now after not believing that it would happen at all? Now it's turned the other way, like, oh, maybe this can actually happen. And, honestly, I could see the argument for that in terms of like the numbers with the job market and what the amount of job openings that there are. We've talked about this before. There's still about 10 million job openings. So if you're, saying those will go away, and people won't actually lose jobs, but new positions that could have been filled or been productive are going away, that's still recessionary. It's just maybe not hundreds of thousands of people are losing their jobs. So,
right.
Meantime, you have the rising prices still going on. So it's not exactly rosy, but it might not be the worst case scenario that people may have thought about.
Yeah, it'll always turn out different than the sort of extreme binary outcomes that are very easy. It's easy to sort of grip onto an extreme narrative, and life is more complicated than that. It is until it isn't anyway. It is right up until September 2008, and then everybody's whoa,
Right.
But those moments are rare enough that it's foolish to get too much certainty about predicting anything, let alone something that rare. So we'll see.
Right.
I think different for the next several years versus the last several is enough for me. It's enough to say, ooh, the tailwinds aren't there anymore. So be prepared. I think that's more than enough for me.
Yes, me too. That's enough of a starting point.
Yep.
And if you can get to that point, I think you're probably ahead of most people.
That's right. All right. So our starting point will be a good ending point for our rant today. And now let's talk to a guy who hasn't been on the show for a little while. Cullen Roche, very smart guy, very good investor. Let's talk with him. Let's do it right now. Two legendary market experts are stepping forward to warn we're in the earliest stages of what they call the Great Unraveling, a specific event starting to take root in America that's behind the recent crash in stocks and the record inflation you're seeing. But they worry it's about to get even worse. And many of the things you take for granted are due to a big disruption in the months ahead. Your Social Security benefits will likely be slashed. Your taxes are probably going way up. And many of your investments are likely to continue falling, meaning if you think you've saved enough money to retire, you're probably going to need way more money than you thought. Your personal success all comes down to how well you understand what's heading your way. This is why I strongly encourage you to read about their warning totally free today. It's all spelled out in a free report we've put together about the Great Unraveling. Get the facts yourself. Go to www.2023unraveling.com to get your free copy of this report. You can learn how to get their full playbook to prepare for what's coming. Again, that's www.2023unraveling.com for a free copy of this new report. Cullen, welcome back to the show. Good to see you again.
Yeah, great to be back. Happy New Year.
Yeah, Happy New Year to you too. It's been a
Are
while.
we still saying that? How long can we say Happy New Year?
Yeah, I don't know. Maybe until the end of January.
I'm just gonna say it all year.
Yeah.
Is that all right?
It's still
Is
pretty
that
new.
cool if I'm into like September and I'm saying Happy New Year,
Yeah.
Dan?
Well, past the first couple of months, I think it's probably not appropriate, but it is still quite new. And I just want to dive straight into the reason why I asked you to come on, because we haven't talked in quite a while, actually. That's certainly one reason, and I like to get you on here as regularly as possible. And the second one is this tweet that you recently put out, which kind of hit home for me because it's a question I ask a lot. You said, "Will the next 40 years of stock market performance look like the last 40 years?" I say, "No." What do you think and why? And
Yeah, I think that's right. So here's to kind of, put some numbers to this backdrop. The last 40 years were really unusual for, I think, especially in the United States, for two big reasons. You had a huge tech boom that I think created this divergence between foreign and developed equity market performance.
Mhm.
And then obviously we had the big interest rate tailwind. So falling interest rates for 40 years are a tailwind to the stock market for so many reasons. But the the tech one is almost more interesting. I mean, it's when you look at the actual numbers, you drill down into it. The U.S. stock market generated over 10%, so 10.1% per year since 1982, and did so with a lower standard deviation, so less volatility than the foreign markets, which averaged 6.5%. And to me, that I think a lot of us who have studied stock market history, we kind of get these like fake numbers in our minds about what the stock market will do on average going,
Yeah.
through history and going forward. And
Yep.
I think that number of like 10 to 12% is kind of a number that a lot of people tend to think is really realistic. And
Huge pet peeve of mine, by the way. Continue.
yeah, well, mine too. Because I don't know, I'm a big proponent of, I guess, under promising and hopefully over delivering. But I think that in terms of building a portfolio, it's just super important to have realistic expectations. And so when you get into this mindset of like, the stock market is going to do 10, 15, 20% per year. Well, you get into this mindset of anything that's less than that. You could find yourself in a portfolio that's doing 8% per year, which is frankly fantastic. And you'll still look at it on a relative basis and you'll say, this portfolio sucks. I'm changing everything. I'm going to shift into the Kathy Woods portfolio because that thing's been doing, 25% per year. And that's a lot of the mindset. People get these sort of unrealistic expectations built into their framework.
Mhm.
And then they end up falling for what inevitably ends up often being a lot of behavioral biases across time. And so to me, when you look at the performance of aggregate corporate America, the performance has been actually, on average, the growth of corporate profits has been closer to like 7% over the course of history.
Mhm.
And so if you think of corporate America as being an institute or an entity that basically paid out all of its profits every year, in the form of like a dividend distribution,
Mhm.
well, 7% is actually the sustainable figure, basically, which is interestingly much closer to the international figure that we've seen of 6.5%. And frankly, is just it seems like a much more sustainable figure on average compared to the American markets, which have done so much better. So I know this has been a big theme for a pretty long time of people saying, oh, well, you need to be diversified internationally because of this reason or that reason. But I think over the course of the next 40 years, as this trend really plays out, you're going to see that at a minimum, the divergence between that performance, which is the difference between 10.1 and 6.5 over 40 years, is a huge, huge amount of
Substantial.
money.
Yeah.
I think it's going to converge more and more.
Mhm. That makes a lot of sense to me. Of course, a big part of this argument is tailwinds, interest rates, inflation, et cetera, et cetera. And we got really used to that. I mean, think of
Hmm.
somebody who started investing anytime in the last 40 years. Like they just think, well, you can buy every dip because the market always recovers, it always goes up, the returns are going to be there. And they don't have any sense of like what my friend Vitaly Katzenelson would call a sideways market or a range bound market where
Hmm.
the returns are there. They're like the single digit, like mid upper single digits over maybe 10 or 20 years, but it's a brutal slog. I mean, it can be a
Yeah,
really
it's
brutal
bumpy.
slog.
Yeah, and it's kind of interesting that we're talking right now because I kind of think we're in one of those markets
Yeah.
where, coming off of it's funny. I recorded something with TD yesterday on TV talking about the market environment that we're in and what's the best analogy. And history is never a perfect analogy for the future. But if you held a gun to my head and you asked me what was the best analogy for today, I would argue that the 2001 2002 kind of sideways slog, their grind lower, is a great analogy where
Mhm.
you had this big speculative fervor, huge premium in growth versus value performance, and you had then the air is kind of coming out of this bubble, and you had a lot of the underlying fundamentals for that big blow off, just
Mhm.
they weren't there. And that's actually one of the really interesting things about COVID, is that when you think about everything that kind of happened during COVID, I kind of think that when we reach the other side of this, completely,
Mhm.
2024, 2025, I think a lot of us, or maybe all of us, are going to look back and be like, man, was that like a crazy dream that happened?
Mhm.
Because I think everything's going to kind of just revert back to where we were, and life is going to largely return to what it was pre COVID. And we're going to wake up and be like, man, that was a crazy couple of years. Why did the government print all that money? Why did inflation go so high? Why did I buy Bitcoin at 65,000?
Yeah. Yeah, I think a lot of people are already asking that one. So you put out a video recently that I kind of breezed through earlier, and I noticed that you talked about a couple of things that Jeremy Grantham just wrote about in a recent note, and one of those is housing. And his point was, housing is like it's still really highly valued. I mean, in terms of like house price to income in the US, we're at 6 or so, up from about 4.5, maybe 11 years ago, 12 years ago. But he says the rest of the world, London, Paris, Vancouver, Sydney, all these places, they're between 10 and 20 times income. Now,
Yeah.
look, real estate markets are local, they're different. I get it. But still, those are pretty extreme numbers. And, even you could just stay focused in the US and say, wow, if this thing might have a long way to go. But what are your thoughts about housing right now and in the next maybe few years?
Well, again, it's kind of the COVID boom, kind of throws everything for a loop here, because the old rule of thumb used to be that, in terms of your disposable income, you spend something like 25 to 30% of your income on housing or shelter. So what happened though with the current cost of where mortgages are and rents and everything, the cost of that now is closer to like 40%. So if you're rolling into a new mortgage from your old one, which a lot of people are kind of locked out of, I think, transitioning from a new house at this point, just because they're locked into the golden handcuff of the low mortgage rate that they locked in back during the pre-COVID period. But those numbers are interesting because you have to ask yourself. So COVID made houses obviously much more valuable, for the main reason being that for a lot of us, your house became your office. So in a certain sense, the sort of premium that we're seeing in terms of the way people are valuing homes makes sense, because, well, if your house is now your office, you obviously are willing to pay a lot more for that thing. But the question is like, is this going to sustain itself? Is the work from home here forever? And if it's not, does that mean that there is potentially a lot more downside in housing than people think? And, it's crazy to look at how far and how fast the real estate market came, because that 40% jump during COVID, what that means basically is that if we were to have a 25% decline in housing, which is a really substantial decline in housing, that would only take us back to 2020. And if you remember the pre-COVID period, people were already saying, looking especially in those foreign markets, like, the crazy Canadian markets and a lot of the foreign
Yeah.
markets, they were already saying these houses are totally unaffordable. This market is a crazy speculative fervor. It needs to collapse. And everything kind of just kept rolling, in large part because of I think largely because of the stimulus from
For
COVID and
sure.
all the complexities of everything that was going on. But that's crazy to think that a 25% decline just takes us back to where we were in 2020. And what does that do? If that actually happened, which would not be crazy at all, I don't think. It's an outlier outcome probably,
Yeah.
but would really not be that crazy. What does that do to everything else? And I think that's a really rational, realistic risk to talk about. And
Yeah.
a lot of people, the other crazy thing with real estate is that real estate is a huge, slow moving beast. Nothing fast happens in
I
the real
know.
estate market. And I think that it's funny, especially right now, like this month, I saw that like Redfin came out this morning and said that like, oh, the real estate bull market is back. And it's like, we've only been in a real estate bear market for prices, first of all, are down like, I don't know, and the national Case Shiller is like down like, I don't know, maybe 3 to 5%, something like
Yep.
that. But we're potentially, I mean, when you look at past bull and bear markets in real estate, we're potentially so early in the way this is all playing out
Yeah.
that I kind of think it's crazy to look at this and start like picking bottoms, so early into something that is probably, in my view, you're going to be, like you said, kind of a slow grind, either at a minimum, I think sideways, with all probability, probably a grind lower.
Yeah, yeah. I mean, even though the events may be different, like pre-financial crisis, it was like the peak was in 2006, the bottom was in 2012. I mean, it's just like,
Yeah.
whoa. Six.
Yeah, that's just how real estate works. I
Yeah.
mean, God, I live in the worst state for this, where, California, where, and it took me 18 months to get a permit when I remodeled my home. And grant, we did a lot and we had some weird environmental stuff because I have like a creek on my lot, which is, I'm the biggest idiot in the world for buying a environmental hazard
Right.
in
I
California.
know.
But um, still 18 months, it's like, as I was going through this process, I was going down to the building department at times and being like, are you people out of your minds? Like, why can't someone review this and just put a stamp on it?
Yeah.
Because this is so obviously done at this point. And it went on and on. It went to the state bounced it back to the city. And it was like, this is so dysfunctional. And then you get into the actual building process, and it's like, the developer says, oh, this is going to take 9 months. And you're like, you're full of it. This is going to take 12 months, right? And he's
Mhm.
like, yeah, probably. And then it takes 15
Yep.
months. It's like,
That's how it works.
but that's how real estate is. I mean, you're talking multiple years
Yeah.
for everything to play out. And a lot of like the inventory issues and stuff that are going on right now, that's builders who started building these homes,
Mhm.
2 years ago.
Yeah.
That inventory is just coming onto the market now.
Mhm.
So this, I think, is going to play out over a much longer period than people think.
Yep. And on the other side, we're talking about people working at home now, changing the dynamic a little bit. On the other side of that, like the commercial structures that they're levered up for 100% occupancy, and they're like, 50% occupied trying to roll these loans. I feel like that's going to get really ugly. And
Yeah,
oof.
that's a really interesting one. I mean, in the last like 2 or 3 years, I have been relentlessly bombarded by like real estate investment trust, these private REITs that were coming at us. And some of them are actually publicly listed, but they don't, a lot of the ways these things work is they don't actually mark their valuations to market, because they really can't. So
Yeah.
like, it's crazy though, because some of these firms would send me their pitch decks, and like you look at like the net asset value of these mutual funds, or their product, privately listed REITs in a lot of cases, and it is, I mean, I don't want to say it's Bernie Madoff, but I don't know if you remember the Bernie Madoff chart of the performance of his fund, but man, that thing was just like it was a straight line. It was
Oh
like
yeah.
almost like looking at like,
45-degree
the
angle
CD.
up and to the right forever.
Yeah, it
Yeah.
was
Yeah.
perfect. It was the perfect
Yeah.
performance chart.
No matter
And a
what
lot of
market,
these REITs,
just
yeah. But when you look at a lot of these real estate funds, they look really similar.
yes.
The pitch decks sound the same. They're like, you generate 6% tax advantage with a standard deviation of 2. And you're like, what? That thing, I'm sorry, maybe that thing can exist for 5 to 10 year periods when markets are just, the way they were sort of pre-COVID. But man, I don't know. Maybe I'm jaded by having lived through a few, big bear markets,
Yeah.
but I feel like these things never last. And so I don't know. I know some people who are rolling money out of those funds, and I'm like, this is a great time to take a breather on stuff like that and just step back and let this thing play out and see, hey,
Right.
you had a really good run, but those charts that go 45 degrees from, bottom left to top right with no volatility, whew, those
Yeah.
those don't stick around for long.
Right. So this reminds me of something else. I saw a little blurb somewhere today that talked about, I think it was on Twitter, and the guy was talking about fraud. And, I thought every time I say fraud, I think of those up and to the right Bernie Madoff returns. It's like, major red flag. And the fact that it was delivered to the SEC 10 times is another thing. But the real point he was trying to make was frauds in public markets. He said there haven't been a lot of them recently, like autonomy, like HP bought autonomy, that turned out bad. And in Wells Fargo, that whole thing with lower level employees committing fraud on these accounts that they were bringing in. But he said nothing else really big in the past several years. And then I thought of the recent ones. They're all private market. FTX,
Hmm.
that company Frank that JP Morgan bought, Theranos. It's all private. They're all, they get to say whatever they want. They can mark anything wherever they want it. And I feel like, okay, this is where the wave of fraud is going to come from, right? Because they're the up and to the
Yeah.
right. That's the up and to the right valuations and things. And I don't know. I always wonder, like, what's the connection to public markets? What's
Yeah, and what's lurking? I
yeah.
mean, that's the crazy thing. I mean, I think for sure you can look at the last 2 years and just say, this was one of the stupidest environments we ever saw. Like all the stuff that has been going on, the whether it was like I remember when like Gene Fama and Richard Thaler used to have arguments about like efficient markets, and there would be like these like sort of like strange things that would happen in like funds that like somebody mentioned something idiotic on CNBC and the stock goes up 1,000,000% and it stays there for a few days. And Thaler would say, see, markets are inefficient. And Fama would say, well, no, let it play out because markets are efficient and they'll, it'll just, or it'll right itself in the long run. So, Thaler is a famous behavioralist who would argue that markets are driven by irrational behavior and, due to prone to inefficiencies. And Fama's the opposite, who's like kind of like a no, markets are perfect and they get everything right in the long run. And so the truth is probably somewhere in the middle, in my view. But the last few years, I mean, you can look at some stuff and this is still going on, where things like GameStop and AMC and a lot of these stocks that were really just had no fundamental basis for making the moves that they made are still really high compared to where they were. And so I don't know. And there's so many more examples outside of, obviously, like you could look at almost 99% of the crypto market and make basically the same argument. How much of that was just silliness that is still kind of, playing out and being digested by the market over time. And I still think, 5 years out, we'll look back and, there's I don't want to say there's certainly some sort of like humongous fraud lurking, but the FTX thing, it's interesting. Like people were talking about it like it was such a big deal at the time, but I mean, in inflation adjusted terms, FTX was not a big fraud. It was an important fraud because they defrauded a lot of people who couldn't afford to be defrauded because the average account value there was, something like, I don't know, $1,000 or something. But in terms of like big corporate frauds historically, especially in inflation adjusted terms, FTX was just not that big and the crypto market is not that big. So it is interesting, like, especially in the context of looking at something like real estate, which is the biggest asset class in the world by, orders of magnitudes, what is lurking out there? And it's weird going through this sort of grinding process that we're going through now because you don't actually see the skeletons in the closet until you start opening up the doors. And you have to start wondering at this point, like, how many doors have we actually opened and how many doors, are left to be open? So I don't know. predicting frauds is obviously like a haphazard sort of way to manage your investments. But I think realistically, I mean, looking at just the amount of sheer craziness we saw in 2020, to see nothing on the other side of that in terms of like a really big fraud would be really surprising.
Right. The point is not to predict it. It's just it's like a characteristic of these kind of aftermath grinding periods, and I just wanted to throw it
Yeah.
in there. But the other thing about the most massive asset class, real estate, is like substantial leverage is just de rigueur. That's just we don't even think about not using substantial leverage. It's like whoa, when things go south, poof, they go south in a bigger way because of that.
And especially related to the way that credit cycles work. I
Mm,
mean, this is, I think, really important to understand in the context of what's going on now, because the Fed just moved really fast, the fastest they've ever moved. And in such a big move relative to the time frame over which they did it.
mhm.
And a lot of the refinancing that needs to be done, and the mortgage market is a lot healthier than it was in 2008, so I don't know how much of a worry like a repeat of 2008 is, but
Right.
I think in the corporate market it's probably a much bigger issue. Probably on the consumer household balance sheets it's a much bigger issue too, where people now have to refinance everything back into a totally different rate structure. I mean, we basically had for 10 years the whole economy became built on like a 0% interest rate structure, which was equivalent to like
Yeah.
a 3% mortgage rate and super low ability to borrow, to purchase new vehicles and to, run lines of credit, corporate credit, so on and so forth. And now we've only just adjusted upward into this new normal. And I don't know how long is the Fed going to stay where they're at. I think they're at least going to stay where they're at through this year.
Mhm.
But that means that you've got like a full year of refinancing going on across all of credit. That, you know, again, this is something that this is not going to happen quickly. And I don't think that we're not at the end of the tunnel here in terms of how this is all played out.
Right, so are you telling me you think, like, rates, could be higher for longer? A lot of people are talking about the Fed even cutting this year, by the end of this year. Inflation higher for longer? Tell me about how you feel about
Well,
each of
so
those.
here's the interesting thing about this is that I in my full year outlook I said that 2023 was going to be the year of disinflation, which is it basically means a positive rate of falling inflation. So it's like going from 5% to 4 to 3 to 2 is what economists call a disinflation.
Mhm,
So you still have increasing inflation year over year, but relative to where it's been, it's declining. And so I think that over the course of this year, I mean, just the year over year comps and the normalization of the economy, supply chains, things like that, it all to me points to the year over year comps are going to lead to lower rates of inflation.
mhm,
So I think that like core personal consumption expenditures inflation, which is what the Fed cares about, that's the indicator that they care most about.
mhm,
I think that's going to end the year at 3%. It peaked at like 5.4,
mhm,
and it's been ticking lower
right.
kind of continuously throughout the last few months. So even if we get to 3, though, the Fed's target is 2% there.
Yeah,
So even if we end the year at 3, we're still way above the Fed's target rate, which to me, that translates into a situation where the Fed is going to, I think, over the course of the next couple Fed meetings, they're going to move the rate to 5.
mhm,
I don't care how they get there, whether they do 50 bip. People have all these debates about 50 bips versus 75 versus.
25
It's
or
like I
what,
don't
yeah,
care. They're going to get to 5. They're going
exactly.
to get to 5, and I think they're going to kind of hold it there for basically the whole year as they kind of wait and see what happens with inflation. Honestly, like the other big debate that people have been having is the Fed going to pivot? And to me, like they're not going to pivot. They're not going to make this like big, glorious pivot at some point. I think the only situation in which they sort of start to move the opposite direction really quickly is if things start to go south really fast. If the unemployment rate
Sure.
starts to tick up a lot faster than they expected. In that scenario, you won't even get a pivot. They're going to be backpedaling basically. They're going to be backpedaling back to where they, say something like 2 to 3% overnight rate. And but I don't think that the likelihood of that happening this year, I don't peg that as being very high. I
Yeah.
think they're going to remain at 5 for basically the whole year. We're going to see you're going to be able to buy a 5% yielding treasury bill in a few months. It's going to be one of the best deals that we've seen in decades. I mean, not since like the beginning of my career
Mhm.
were we able to buy 5% treasury bills. And so I think the Fed's going to sit tight and the inflation's going to remain higher than they expect, which means that everything in the credit markets is going to remain tighter than the Fed or than markets are probably pricing in even right now.
Yeah, and as soon as you told me, let me just go back a little bit. As soon as you mentioned getting to about 3% inflation by the end of the year, my first thought was this sort of what I think of as a double lag effect in Fed policy, right? They come up to a certain moment in time, they look backwards. It's backward looking data that they're using. So call it a month or three or
Hmm.
something. And then the policy is executed, and that the effect of it lags, some they say 6 or so months into the future. So I think if they're looking at all these numbers that we're discussing and they come up with 3% in December, let's say, are they ever going to begin to appreciate the lagging nature of the policy execution? Are they going to say, well, it's 3 now, but we're at 5 plus maybe on the Fed funds, so let's just take a breather. That sounds like you are confident that they will finally sort of figure that out. They don't seem to have figured it out yet.
I don't know. I mean, there's the outlier scenario is does 5% on the overnight rate cause a lot more problems in credit markets than they expect? I think that's
Right.
so this debate is weird. I try to be at least somewhat understanding of the Fed because like
Yeah.
their their job is impossible. And I think what they're really, really worried about is they're worried about a return of the 1970s. And so they want to get ahead of that, the cart there. But I don't know. To me, the risk of the 1970s and like the wage price spiral and like a lot of the dynamics that you had in the 70s are just, to me, they're not
Yeah.
there. This is not an environment that looks a lot like the 1970s. And I think that's starting to kind of play out in the data now.
Mhm.
But the Fed is all the Fed officials, everyone in the Fed is, they lived through that era. They're hyper worried about it. And to their credit, I mean, 10 years, we lived through like 1 to 2 years of pretty high inflation, which is, sucky in a lot of ways. But
Mhm.
imagine 10 years of it. I mean, 10 years of 10% inflation it's really horrible, really
Yeah,
catastrophic. And
and
so,
again, at least the first portion of that period, the Arthur Burns portion, like, it would ratchet it up and down. That was the nature
yeah.
of his, widely touted failure was that when inflation numbers sank, he said, "Hey, we've licked it. It's done."
Yep.
And was not because it's
And
such
that's
a sticky
exactly,
effect.
yeah, that's exactly what they don't want to do in this environment.
Right.
They don't want to cut rates down to 3 and then get a big surge in demand that causes another big jump in inflation. So they're hyper worried. That's part of why I think that the really likely scenario going forward is that they're likely to stay higher for longer and keep rates, 5% plus
Mhm.
for at least this year, I think.
Yeah.
But it's weird because if I'm right that this is not the 1970s and that this is more analogous to like I don't want to say 2008, but like a 2001, 2002, where corporate credit is pretty fragile.
Mhm.
Um, you get lower inflation than you want and higher unemployment than you want, which is creates kind of the exact opposite of what the Fed is really positioned for. And I don't know how. I mean, I think they're cognizant of that risk, but it certainly does not seem to be the consensus view that they are more worried about that than say the return of the 1970s.
Yeah, let's look at inflation from another angle that you looked at in your recent video. You talked about something that's become important to me, the dollar index. Why don't you? I don't want to spoil it. I want you to tell it. So why don't you tell our listeners what the scenario that you're kind of it seemed like that was the bigger one that you
Yeah.
were discounting.
Yeah, so the dollar is another sort of huge tailwind, especially for U.S. markets. It really interesting to look at the dollar relative to everything else, especially in the scope of like COVID, because you could look at, I mean, you could have gone back to 2020, and I remember when we talked back during the earlier parts of COVID, and I'm a lot of people know me for being sort of not a deflationist, but a disinflationist for like
Mm.
10 years coming out of the financial crisis. Because I was basically saying that like monetary policy and quantitative easing doesn't cause inflation. Fiscal policy is the thing that causes inflation. And we haven't had huge fiscal policy. So, the government spending just wasn't there to cause like a really high inflation coming out of the financial crisis. Whereas with COVID, I was like, holy cow, we're spending an incredible amount of money. And inflation went higher than I expected it to, but it's still, I expected inflation to be much higher than I think a lot of other people expected, certainly the Fed. But the interesting thing with that is that even in the context of that, you could have looked at all of the relative currencies and said, what's going to happen to the dollar in that scenario? And the scenario where the dollar rallies against everything, I think is shocked a lot of people.
Mm.
And that's just the fact that the dollar, even with this crazy high inflation that we've had the last few years, everyone else had higher inflation basically. So like the dollar was still the strongest, currency in a horrible neighborhood of fiat currencies. But I think the worm is turning on that though, where especially on the relative interest rate dynamics, I think what's happening is that the Fed, even though they're not going to move to a lower rate position, the Fed has been much more aggressive than a lot of foreign central banks. And so on a relative basis, the dollar has rallied in large part because the interest rate dynamics have been so much more aggressive in the USA.
Mm-hmm.
And I think we've started to see that already in the reversal of the dollar index in the last few months, few quarters.
Mm-hmm.
But I think it's going to continue for, this year, maybe a couple more years.
The
As
reversal,
I think,
the
I
decline.
think foreign central banks continue to be really aggressive fighting inflation, and I think the Fed's mission is done. Even though they're going to stand, pat with where they are, I think that the Fed's battle against inflation is over. Whereas the risk of inflation especially in places like Europe, where they have the huge energy exposure and so many of the mishaps with policy there,
Mm-hmm.
they have a lot more inflation risk that's going to be a persistent type of inflation risk relative to the United States. So I think they're going to be fighting a different battle for potentially much longer. That's assuming you don't get that outlier scenario where things sort of get really crashy in a lot of other markets. But even in that scenario, I think inflation is going to be high on a relative basis in foreign markets versus the USA.
Okay, so let's talk about what to do about all this. Your model that you use at Discipline Funds is in major risk-off mode. I mean, it seems to be all the way down at the bottom of the graph that you published in risk-off mode. But I thought you had an
Yeah.
interesting idea that I hope you'll talk about, which is diversification across time. What do you mean by that?
Well, yeah. So, it's interesting. I basically use a counter cyclical approach to asset allocation. So I like owning stocks and bonds and other asset classes. But I think the thing that sort of always struck me as being really strange with the way that, especially a lot of the big index funds, the way they rebalance is that they always rebalance back to a fixed weight. And what's weird is that, and the thing that a lot of people don't look at is that the relative market caps of the stock market versus the bond market, it changes a huge amount every year. And so if you were following like a really efficient market hypothesis approach to asset allocation, well, you would track those actual market changes. But the weird thing is that behaviorally, that's the exact wrong way to manage money, because what typically happens is the stock market cap booms during periods like 2007, 1999, big bull markets. That's when the stock market capitalization, the percentage of the stock market's value relative to the bond market, it booms. So the bond market typically doesn't grow very much. So the stock market tends to cause these big gyrations. And interestingly, when you look at the data, it kind of moves. And the stock market is typically, like in the early 90s, it was 35% of market cap. It grows to 50% by 1999. It crashes back to 35% by 2003. It grows back to 50% by 2007. It crashes back to 35 in 2009. And then it kind of grew back to 50 by like 2016 and sort of stayed pegged there. But so behaviorally, the right thing to do if you're trying to navigate all the volatility of the stock market is basically to do the opposite of what the market cap of the stock market booms and busts are over time. And that's kind of the approach that I take, because I'm just hyper sensitive to people's worries about this. I think the stock market is what drives the majority of people's concerns in the financial markets over the long term, because the stock market is just so volatile relative to everything else. So if you can kind of throttle the stock market's volatility, you can create a much more behaviorally robust asset allocation. And so right now, we're still in one of these environments where the model was very bearish coming into last year, and it hasn't really changed that much coming into this year. So still in kind of a risk off mode. But the more important thing is that, we use that model kind of as like a core position for a stock bond multi-asset allocation. The much more important, I think, component of asset allocation for me is that a lot of asset managers, really the whole industry, we talk about when we build portfolios, we typically will run like a back test of like different asset allocations and look at like it spits out, the best risk adjusted asset allocation. Then you say like, oh, well, you're 50 years old and you've got this risk tolerance. So the best risk adjusted portfolio for you is 50% stocks and 25% bonds and 10% gold and yada, yada, yada. And, and then you slap that together and the person ends up holding this sort of mishmash of different stuff. And the problem with that is that none of us live our lives in this sort of risk adjusted asset allocation model. We all live our lives based on the way that our liabilities change across time. And so we all have monthly liabilities that, a mortgage, your rent, your credit card payment. If you've got, kids planning for college, you've got, 5 to 10 year expenses. If you're planning a down payment on a house, let's say you've got 2 to 3 year money that you need. And this is how actual life works across time, is that we have all these liabilities across all these different time horizons. And when you take a portfolio that is just a mishmash of all this stuff, well, when you need the down payment for the house and the stock market is down, 50%, or, the bond market is down like it was last year. Well, this mishmash of assets, it causes a big, what's called an asset liability mismatch, basically, where you've got short-term liabilities that need to be funded, but your assets are all down in value. And so I've become a big advocate. I wrote a paper called All Duration Investing, and it's sort of the methodology that I use now, where instead of looking at diversification across the best risk adjusted asset classes, I try to apply actual durations to every asset class that we have. And so in terms of the actual figures, like a treasury bill is basically think of it as like a 0 to 1 year instrument. That's your cash like instrument that that across certain time horizons, even if inflation is raging, in nominal terms, that principal certainty is pretty clear. You can look at something like, a short-term government bond fund, like something like the Vanguard short-term government bond fund is basically like a 2-year instrument. The aggregate bond market is like a 6-year instrument. The stock market in my model ends up being basically an 18-year instrument. Things like gold and commodities end up being basically 30-year instruments. I actually like to think of gold and commodities as more like they're insurance. They operate like, if you think of what an insurance contract actually is, an insurance contract is typically a very long-term instrument that generates a negative return on average, actually. But in certain environments, it'll generate very, very high sort of asymmetric returns. And that's what gold and commodities are really similar to. They're instruments that they don't generate consistent cash flows like stocks and bonds do, but in certain environments, they'll outperform for very specific reasons that are generally operating like insurance relative to stocks and bonds. And so, yeah, I've become a big advocate of building portfolios, working mainly from the liability side, looking at someone's financial plan based on how they spend their money, and then saying, look, I know that treasury bills right now are only yielding 4.5%, which that that sucks compared to the long-term average return of stocks over the course of time. But this is a financially appropriate holding for you for X amount of dollars for you, because when the stock market and the long-term bond market are doing terribly, that treasury bill position will give you the peace of mind to know, hey, I've got this amount of money laid out for this number of years, and I don't have to sweat what the stock market is doing, because I know that the stock market is an 18-year instrument that you just let it ride. You don't worry about what it does over the course of 18 minutes or 18 months.
Okay, and folks who want to find about more about you and about these ideas can go to disciplinefunds.com and find you on Twitter at Cullen Roche.
Yep.
We've come to our moment when I ask my final question, which is the same question for every guest, no matter what the topic. You've answered it once or twice yourself, and here it is again. So if you could leave our listeners with a single idea, even if you already stated it, by all means, just say, "Hey, that was it." But if you could leave them with a single idea today, what would it be?
You want an asset allocation idea or just a general philosophical idea?
You can go anywhere you want with it.
I think that I think I said something similar in a previous episode where I said patience was really important. But speaking of this sort of all duration framework, I'm so much more convinced now than ever, especially after having gone through COVID, that managing your assets and liabilities and accounting for time it's the crucial aspect of good financial planning, in my opinion. And that approach is so different than the way that a lot of portfolio management is done, where so many of us look at things like stocks and bonds and we talk about stocks for the long run, or gold for the long run, or whatever it might be. And the reality is that none of us really, we don't have a long run for all of our assets. We have all these different time horizons. And I think when you can introduce the aspect of time, you're kind of solving for the last big problem in portfolio management, because building a really good risk adjusted return portfolio, that concept may put together a portfolio that has a lot of great aspects that might be appropriate for a certain risk profile or risk adjusted style return over the long term, but it doesn't help you plan for time. And I think when you start to build in that component of time into your portfolio and thinking of things across time horizons rather than just what is the best long-term performing portfolio of cobbled together assets, break them down into specific time horizons. And that way, you can afford to be patient with certain amounts of your money because you're impatient with other components of your money, because that's the way we all live our financial lives. We're impatient with certain liabilities. And if you take care of those liabilities by matching them with certain assets, it gives you the ability to live through periods like COVID where you can afford to be patient with other money because you know that you've got impatient money to kind of offset it.
Nice. Yeah. I like the way you talk about time and patience. That's awesome. Well, thanks for that.
Yeah, well, I got young kids and I'm getting old and I'm running out of time. So it's something that I'm like becoming obsessive about.
Yeah.
So
Yeah, I can see it. Yeah. But you're doing something about it. It's great. So listen, thanks for being here. It's always a pleasure to talk with you. And I'm sure our listeners got a lot out of this.
yeah, well, Happy New Year,
Yeah.
everybody.
All right. Thanks a lot, man.
All right, Dan, great talking.
Many mainstream analysts are predicting that stocks will recover soon. But I say we'll instead witness a cash frenzy unlike we've experienced in 21 years before stocks recover. And I'm urging Americans not to buy a single stock until they see it. I predicted the Lehman Brothers crash in 2008, and I called the top of the NASDAQ in 2021. But this is the number one most important thing to pay attention to for 2023. And I'm not talking about another market crash or politics or inflation or any of these other things. As all this unfolds, the financial consequences of what I'm talking about could last for several decades if you don't understand what's happening. There will be winners and losers, and now is the time to decide which one you'll be. This is why I strongly encourage you to read about my warning totally free today. It's all spelled out in a free report we've put together. Get the facts yourself. Go to www.stockdeadzone.com to get your free copy of this report. You can learn how to get my 4 steps to prepare for what's coming. Again, that's www.stockdeadzone for a free copy of this new report. Hey, how about that? That's like, the third or fourth interview we've done fairly recently where the issue of time has been really important. And when I think about just sort of the typical mistakes that investors make, as Cullen was talking, I was thinking about it. He's talking about the way we live our lives and how people need more patience and they need to match their assets and their liabilities. I was thinking, one of the big mistakes that investors make is they're not patient enough. They're not patient enough with their stocks. Like he said, it's an 18-year asset class in his view, versus, shorter term bonds or something that makes more sense to liquidate in the shorter term. So I thought that was a really great discussion with him. Like for that reason alone, let alone all the other insights he had about housing and the Fed and so forth. Always a pleasure to talk with Cullen. Really smart guy, really sort of conservative, focused, risk-adjusted thinking kind of investor, and just an all-around smart, good guy. And that's why we check in with him on a regular basis. I don't think we'll wait so long next time. All right. Well, that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and you know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com. Do me a favor too, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_Hour. If you have a guest you want us to interview, drop us a note at feedback@investorhour.com or call our listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.